Inflation remains above the Fed's 2% inflation target. The core consumer price index averaged an annualized rate of 2.85% over the last 6 months. The core producer price index averaged an annualized rate of 3.4% over that period. And the one-year break-even rate, which is really market expectations for average inflation, sits at about 2.6%. These three measures show inflation has been above 2% and is expected to remain there. Now, Fed officials undoubtedly debated whether to cut or not, and they ended up dropping rates 1/4 point. The Fed also issued its latest Summary of Economic Projections, or what they call the SEP. So what did we learn? The median projection from officials for core PCE inflation is 2.5%, so above that 2% level. The median GDP growth rate is now at 2.1%, the long-term level of trend growth. And the median funds rate projection is 3.9%, so reflecting a 0.5 point in cuts next year. The Fed is slowing down on rate cuts. In fact, Fed funds futures are signaling just a 1/4 point cut next year. In response to all of this, market interest rates jumped after the meeting, with the 10-year Treasury yield rising to over 4.5%. Stocks moved lower, with the S&P 500 down 2.95% and the NASDAQ down 3.56% for the day. The Fed cut rates as expected, but is signaling fewer cuts next year. This week in Sightlines, we review inflation, Fed policy actions, and the economic and market implications of this policy shift.